Hello guys, good morning. There is a question in one of the WhatsApp groups of FMLI on what is exchange traded funds ETF. Let me explain this to you because whatever you'll get in books or Google or Udemy will actually not be very clear and it will be very theoretical. Whereas the difference actually lies in the practicality aspects of it. So an exchange traded fund is very much like a mutual fund that helps you diversify your investment. Why do you need this diversification? Simply because if you are say bullish about pharma stocks and you end up buying stocks of Dr. Reddy's, but actually Lupin goes up or Sun Pharma goes up, then you end up holding dud stocks. And second is on risk also. So if you hold one or two stocks and the stock prices fall, then some stock prices naturally fall much more than the others. So diversification actually gives you averaging out benefits. No, okay. And the second thing is that it is very costly to do individual research of individual stocks. Okay, so large institutions they want to avoid that, and whenever they take a view for the entire segment. So they say auto will go up, or banking will go up, or pharma will go up, and they want to take exposure in the entire basket of securities. And so it is very much like mutual fund. However, the important thing is that the similarities actually end there between mutual funds and ETF. Mutual funds are more suited for retail, okay, where they are not very price conscious, cost conscious, and they want to hold for a very long period of time. ETFs, on the other hand, provides diversification benefits to institutional investors. Now, there are some things that institutional investors demand that mutual fund don't service, okay, and which is serviced by ETF. The first thing is immediacy. Mutual funds demand, institutional investors demand immediacy. When they want to get in, they want to get into a particular segment within seconds, and when they want to get out, they want to get out within seconds. In mutual funds, what happens is you make an application and then you wait for the end of the day prices, okay, or end of the day NAVs, you are allocated units. It's a very slow process. Retail can live with this slow process, but institutions can't. When they want to get in within seconds and get out within seconds, only an exchange traded funds can do that. Second is transparency in prices. When mutual funds actually allot you units, they allot at the end of the day NAVs. And for institutional investors, that's a huge problem because if they wait till the end of the day, the prices may vary by 4 or 5%, which is pretty significant for large volumes of transactions. So, when large institutional investors want to get in and get out, they want to know the prices exact at the point of time when they are transacting, and they don't want to take any variation risk in these prices. So ETFs, because they are traded on the exchange, they know the prices immediately when they are getting in and getting out. And the price discovery process of the exchange is also something that comforts large institutional investors. They know that the prices that are traded on the exchange are actually a collective reflection of everybody's views, and it is not something opaque like the NAV where they have to wait till the end of the day. You know that stock prices can actually change significantly even during the day. So large investors prefer ETFs as a product. And because these ETFs tend to be very liquid, the cost of transacting in them is also very less. One very important aspect is the cost of mutual fund tends to be very high because they are actively managed. Okay, so a mutual fund, for example, charges 1.5 to 2% per annum of the asset under management as their AMC fees. Okay, and this 1.5 2% is too high for institutional investors. ETFs, on the other hand, are passively managed, so the asset management charges are about 25 basis points. So this 1.25 to 1.75 percentage of saving itself over 10-year period translates into 15 to 17.5% of the value of the investment. Okay, so for institutions, this saving is very huge, and they are very very cost conscious and liquidity conscious and immediacy conscious. Okay, when a institutional investor gets into office in the morning, the fund manager wants to get into say a particular segment, okay, for auto for example, and when he wants to take exposure, he wants to complete his exposure within the first 5 minutes itself. Okay, and mutual fund is a very slow process. The unit allocation takes 2 days. So mutual fund is more suited for retail, and ETFs are more suited for institutional investors. Okay, I hope this difference is clear. Everywhere you will find the similarities, but actually these differences are actually the things that matter. However, having said this, there are now better alternatives available for fund managers to take sectoral exposure. Okay, for example, now there are a lot of indices available, indexes. So there is, for example, index for banking. So institutional investors actually can get in and get out of banking index very fast, as they can get in and get out of ETFs. So this is a process of evolution. First, there were individual stocks available, but they created problems. So that they then came mutual funds, but they have their own set of problems. So to solve that, actually for large investors, ETFs came. Okay, but now there are better products like indices. So institutional investors now prefer getting in and getting out of indexes. I hope this answers. If you still have questions, you can WhatsApp me individually. Thank you. Bye bye.